Good morning. To just give you a bit of background, I'm from the Industrial Development Corporation. So we are a development bank that looks at giving funding to businesses in our strategies. And one of those are telecoms, and our two strategies in telecoms is to increase penetration and to bring down costs. So we've often looked at WAPA and thought, surely there are some businesses that want our funding. So we've done a similar presentation before, but now it's just tailor-made specifically for today. And one of the things I wanted to highlight was several things that we look for in a business case, and that's telecom partnerships to enhance business models. So just what we're talking about today, the market disruptors, discrete scaling, case studies, and a bit about business plans. Okay. So in the last while, seen a number of companies come into the market and really disrupt the telecoms market. So what do they all have in common? They've been using partnerships to compete with the vertically integrated monoliths like Telkom, Neotel, and bit by bit, they've been eroding the market share. So if we have a look at some of them, DFA, or IDC specifically looks at infrastructure funding. So DFA would be a prime example of how DFA owns the infrastructure and uses a partnership with the ISPs to actually reach the customers. And if you look at the DFA market case, you'll see that they have built their network off the back of the demand from the mobile phone providers. And that way, they've found that they've been able to raise funding. The other ones, Vumatel, MFN, are also providers of infrastructure, and Cool Ideas, Greencom, and IS are all the ISPs that have used this infrastructure and managed to grow the business. Comsol is a very interesting one, and it's a case study that I'd actually like to discuss a bit later, and that's because Comsol has leveraged both the fiber backbone of the country with Neotel and Telkom, and then they've used the last mile fiber open access provider, and then have the ISPs on top of that. So through partnerships of both fiber and the ISPs, Comsol has presented a fundable business case that we've managed to fund. So what does this partnership and the collaboration actually bring to the party? Well, there's new models, there's faster growth. What happens is that the companies that are most suited to take on the risk, and it makes there's less risk. And you combine industry strengths, so that where ISPs might have billing and debt collection and relationship with the customers and a national presence, the infrastructure owners might have cost optimization. They might be able to focus on an area and not necessarily go nationwide. They can raise the funding. So then the other thing is, when we look at business cases, at the IDC, we like to start small, to see something work, and then as it grows and it scales, it's easier for us to invest our money as each success happens. So one of the things that we'd like to see in a business plan is a kind of a small case where it's been proven, and often this needs to be funded by shareholder funds, but there are some cases that IDC would step in and give funding for early project development if we see real merit in it. So the cases the way that we like to see it is there would normally be a proof of concept. This would be funded by the shareholders. It would prove the model. It would prove that there's a market, that there's technical skills in the business. And then this can be replicated into a bigger version, which we can apply a small amount of funding for. And as more and more funding gets required, so we can disperse more and more. And we normally do approval rounds in maybe a year of CapEx rollout. So you can shoot for the skies, but you start off with a smaller case and you prove it as you go out. And that's why we really are interested in the WAPA members, because we think if you can prove it in one area, use that same model and move it to another area and expand your business. So some of the case studies that we've funded. And so I must also just point out that we are looking at it from a developmental perspective. So sometimes the banks might look at it at a purely commercial sense, but we obviously value the fact that the penetration has been increased and that the cost is decreasing. So one of the case studies here is a fiber to the business company that we funded. Now, it was very easy to fund this because they had a proof of concept, they'd rolled out in an area, they had contracts with an ISP that had provided pre-sales. So even before they got to the area, the ISPs had brought into the model and said, look, we'll buy 20 leases from you before you even get there, and you can go and raise funding on that. So it was quite easy for us as IDC to fund. The market risk had been mitigated, the technical risk had been mitigated, they'd already rolled out something, they'd shown us how they'd done it, and they grew from one area to 10 areas to 100 areas. The other one, as I mentioned earlier, was Comsol. So we like Comsol because Comsol has been in the industry for about 10 years, and they've had a track record of delivering. They also managed to get relationships with their ISPs to give them pre-sales, but not as much, didn't cover our debt. They used the infrastructure that was already there, which is another thing that's very important for a development bank because we don't really like duplication of infrastructure. Normally, if there is duplication, the people who suffer the most are the funders. So that when companies go bankrupt, it's the funders that suffer. And finally, we have also looked at a Wi-Fi network, which we gave project development funding. We weren't quite sure if it was going to work. And I think Ellie referred to it in her talk earlier. How does one get it to work? Well, we thought we'll throw money at the problem and see if it would. And we came up against a few challenges. So this was in a underserviced area, Soweto. And what we wanted to see was that the lower income portion of the market will have access to Wi-Fi. And the challenges that we came up against were the distribution of the data and the cards was a bit of a problem because the model that they used didn't quite work and they couldn't incentivize the distribution agents to actually distribute because the cost was so small. They were technically sound, but we just didn't have the take-up. So in a case like that, we would look at funding them further, but we'd have to regenerate that business model. And one of the interesting things is that it's been a bit of a process in that case because there wasn't very financially strong people within the company. So that when we asked them to change their business model, it took a long time. We kept getting models that didn't work, and it hasn't been as successful as we'd like. So the talk before was actually on equity-type funding, and I'm talking more about the debt funding, but just to explain that there are two types of funding. There's corporate-backed and cash flow-backed. And if you normally go to a commercial bank, what they'll ask you for is security, whether it's in the form of your house or your company or corporate guarantee. The other type is cash flow backed. And what that means is that your company should be generating cash flows, so that stable cash flows. You should have 3 years of audited financials, and so that the banks will feel comfortable that they can give you money off the back of that. The development type financing often looks at the cash flow backed scenario, where there might not be the security that's available. We'd still expect the entrepreneur to give a personal guarantee, so that if anything goes wrong, if there's no fraud, we can chase after him. But it doesn't mean that he has to have all the assets in his business. He doesn't have to have assets of his own, like his house. He doesn't have to put those in. It's just a general blanket corporate personal guarantee. But the cash flows also, they don't have to be stable. So, for example, if you're thinking about expanding your business, we can look at the projected cash flows that you might give us in your model. So this is about your plan. Okay, so why would you have a plan? Well, you need a plan to present to your funders and possible investors, and even if you want a new idea that you want to bounce off people. Okay, so what's going to be in your plan? You're going to express the role of the stakeholders, and that would be your partnerships. You would have risks, the market, technical side, acquiring towers, and then you define your market quite carefully. Who are you going for? Who are you targeting? What kind of people are out there? How are you going to win them? What's your pricing strategy? And what the competition is like. Then you also want to look at the timelines. So how it's going to look in 1 year, how it's going to look in 5 years, and however long the funding that you require for. So the business plan is all about planning. You want to see insights into the industry and market. You want to see how your CapEx will flow and your funding that will support the CapEx and the marketing operations, people and strategy, and how they interrelate. You want to see the resources, for example, your staff and your suppliers and the equipment that you're going to use, and your goals and how you want to achieve them. So we're looking for how you're going to implement this all, and how you're going to grow your business. So what are the steps? You want to define the initial concept. You want to look at the market and the feasibility. And then you want to assess it and make it better and redefine it. Then you'll write it up, wrap it up, and submit it to a potential funder or investor. So the first one, defining the business concept. What are you going to do? What need are you going to make? Are you going to satisfy? So I came up with 3 that I thought were pertinent to the WAPA members. And one of them is an acquisition or consolidation. I think we were talking about business entrepreneurs that get tired and they want a life. So maybe you want to go and find another entrepreneur to kind of make it a bit easier, or maybe just some skills in another business that you want to acquire, or maybe another market that you feel that another competitor is doing very well in. So there might be synergies, so you can look at acquisitions. I suppose I should just mention that IDC doesn't do very many acquisitions unless they're BEE funding, but there are other institutions like commercial banks that look at that. Then, of course, there's the expansion into the new market, which we like very much because it means growing your penetration. And a new technology, which might mean that a WAPA member would be looking at a fiber rollout or upgrading their technology that they're looking at. So then the next difficult thing is the market research. So the pre-sales that we talked about earlier are sometimes quite difficult to get in underserviced areas or or from businesses that aren't sure of your business plan. So we really need to know who you're targeting. There's sources you can get from internet, experts, suppliers, competitors, customers, door-to-door sales, statistics SA. And what we'd like to see is industry and market dynamics. The historical trends are very important. Surveys, statistics, and please don't come to us and say, there's this size market and we expect to win 10%. That 10% needs to be justified. So the gaps and opportunities are very important, especially in a development finance institution, because we're looking at filling those gaps. Okay? So we would like to see in a business plan what gaps are being addressed, and that the gaps that are addressed are geared towards the market. What's going to distinguish you from your competitors? And as we mentioned earlier, the relationship with partners and suppliers. Finally, the business should be sustainable. That means that you need to generate enough cash to pay back any loan that you would like or you're requesting. That's cash and profit. And then you need to write up the plan. So it would normally include table of contents, executive summary, company description, opportunity, industry and market, strategy, and business model. The management, of course, is very important because often really good managers can take a bad business plan, and transform it into a wonderful business, whereas not very good entrepreneurs can take a wonderful business model and can implode. Then there's the marketing plan, operational plan, and financial plan. So this is an example of a business model that we would expect to receive. This is the income statement, and you can see that we've broken down the turnover into various sectors, so that as an investor we can understand the growth that's projected and base it on your market analysis. Then, of course, the cost of sales that we discussed earlier, that Tim discussed. And that could be bandwidth, CPE costs, whatever, or then, of course, salaries and wages, operational expenses, admin expenses, selling expenses, depreciation. The difference between raising debt and equity is that if you want to inflate that, it's not going to make that much difference to your business case as long as you can pay back the debt. So we're looking for a sustainable business case. It doesn't have to be shooting the lights out. Then, of course, interest paid, and that will depend on what institution you're looking at and what kind of loan you're looking at. And then that will leave you with the profit. So obviously, if you are expanding, we don't expect you to make profit in the first year. There could be a time when you're rolling out the capex and you need some ramp up, and that's something that we could consider if we give you debt. So you can see it's loss-making in the beginning, then turns profitable. Here's an example of the balance sheet that we look at. So just to go through the different lines, your capex, you'd expect to see some growth if there's investment. Depreciation would be over the length of the life of the asset. Your stock would be related to how many, well, in this case, it's related to the CPEs that you roll out. The debtors would be related to your sales. The cash would be a balancing figure. Creditors would be related to your cost of sales. And this would be your loan that you'd be requesting. And you can see it's paid back over the 5 years. And that gives you the leftover portion is the amount of, this will feed from the income statement, which is the retained earnings. So in the wrap-up, what do the readers ask? Is the idea solid? Can they buy into your plan? Is there a market? Are the projections realistic and attractive? Can the management execute on it? And will there be adequate return for the shareholders? That's, of course, we don't want to invest in a business that there's no incentive for the shareholders to actually make work. That's all from me.